Ajay Vora is now joining us, head of listed equity alternatives at Nuvama Asset Management. Ajay, good to have you with us here. Good afternoon. Thanks for your time. Ajay, the market's done well, haven't they? Despite, of course, notwithstanding today's slight pullback. And you believe that from here on, the rally will get narrower. Actually, we've been marveling how, broad-based and inclusive this move higher has been with mid-caps, small caps, a lot of participation really, backed by decent volumes as well. But you're now saying things will get a bit narrower. Could you explain that? And which are the sectors which will come out on top through that narrow funnel?
Sure. So thanks a lot, Prashant, for having me on your show. So when I mean, narrower is broadly, on the large cap side, it's no longer, pretty much a consensus trade that everything will move from here on. And maybe, during March lows, we were in terms of the valuation. But now if you look at it around closer to say 18.5, 19,000, we are trading closer to 20 times FY24. So from now on, you need to see, where the growth can actually outperform. And basis the current, the result season also, the Q4 result season, we saw that the expectation was closer to 12-13% PAT growth at aggregate level. And we actually ended up delivering closer to 20%. So there were clear, beats like Tata Motors and Reliance and a couple of other names, which actually outperformed quite a lot. And therefore, what I meant was that, within the index also, the growth may not continue to be secular across all sectors, but it will be more sector and stock specific. And on the other hand, on the mid-cap side, we are seeing a lot of action. And a classic example to see over here is that, if you look at the overall GST numbers, the way they have moved, that clearly tells you how the formalization of the economy is helping the companies at the bottom end of the pyramid. So we are seeing 30, 40, 50% growth for most of the companies last year and next year as well. And basis that, this action on the mid-cap side can also continue.
Right. You spoke about things being sector and stock specific. The one sector that really stands out is IT in its underperformance. Actually, there's this tug of war always between the Nifty IT as well as the Nifty Bank. It's usually one which moves ahead of the other and supports the frontline index. If you just take a look at the last 12 months, the Nifty Bank has outperformed the IT index by a factor of almost 21, 22 odd %. However, this year so far, they've both been in line. In the meanwhile, we've seen a big move come by in the Nasdaq itself. And the IT index usually is highly correlated to the Nasdaq. There you have it. In the last 12 months, the Nifty Bank is up 23%. The Nifty IT index is down by about 1%. But this year itself, in 2023, both of them have moved around 2.5 to 3% each. Your thoughts on this IT versus bank sort of move, and where do you think this is likely to go? Is it a good time to start nibbling into the IT space?
So Mangala, broadly, the way I would look at it is more on a 12-month basis. And if you look at on a 12-month basis, the Nifty IT index is almost flat. Whereas all other large sectors in our country, like auto, banking, cap goods, or even real estate, all these sectors are up anywhere from 20 to 25%. So what you're saying is absolutely right. So even during this period, Nasdaq is up 12%. But we also need to understand that during last 12 months, this sector was still going through a period of earnings downgrade. And now we feel that, considering a significant underperformance versus other sectors, as well as, the bottoming out of the whole earnings downgrade cycle, we may not see a very much runaway rally for the sector. But we feel that, on the mid-cap IT space, especially, one can look to start accumulating with a 12 to 18 month horizon. But clearly, it is more dependent on how the US economy does. And markets are always forward looking. So our sense is that, large part of the earnings downgrade for most of the companies is behind us.
Is behind. Although, we've not seen any upgrades. At the margin, I still think there are more downgrades than upgrades, right? After the fourth quarter. At a Nifty level, it's only, I think, 1.5, 2%.
Yeah.
But if you look at, say, the top 100 companies or the top 200 companies, there are more which have seen downgrades as compared to upgrades.
You're right, Prashant. So broadly, if you look at the numbers, firstly at the Nifty level, after we finished, 9 months closer in December with the December earnings, the Nifty earnings growth was tracking somewhere close to 8%, and now we have ended the entire year, which is FY23, with 11% growth. So Nifty EPS for FY23 now stands at somewhere close to 815. So that is broadly in line with where we were maybe 6 months back. This was clearly the expectation. But as you are right, on the Nifty 100 companies, there has been a few more downgrades, and I think that is more related to the entire IT sector and also certain company specific issues. But if you look at the companies who are more dependent on consuming commodities, they have seen a reasonably higher margin profile. So if you look at the overall margin profile of Nifty 100 companies, we are back to EBITDA margin of somewhere close to 18%, which it was pre-war era. So in terms of margin profile, we are moving pretty well, and therefore, the growth can continue from here.
All right. And what about your long-short performance? Just wanted to understand, a lot of the mutual funds that a lot of people invest in are fundamental long only. And that's like saying that a batsman is making runs only on the offside. How about long-short performance? Do you think there's a case for that where you make runs on both sides of the wicket?
Yeah, Mangalam. So that's a very good point. And actually, it is very important to understand that gone are the days when, markets can actually continue to rally for 3, 4, 5 years. And you will always have these kind of cycles. So if you look at the data point, we hit a high of 18,600 somewhere in October 21, which was almost 19 months back. And, most of the, I would say, the large cap long only funds would be broadly, flattish versus that period. But, a point in case is that long short funds tend to, manage risk pretty well. And also they have a certain strategy in terms of how they want to allocate their overall exposure. So for a fund like ours, our long short fund, which is Edge, I can just share some data point with you that in October 21, when, as I said, Nifty was at high of 18,600, our NAV was, we were up around 22%. And even today, after 19 months, when the Nifty is still trading at the same level, back to the same level, our NAV has moved to almost 38%. So there is a 16 percentage points alpha on Nifty over a period of 19 months, which is possible mainly because, you end up managing risk pretty systematically and also have a proper allocation to the growing sectors. So that is the kind of outperformance one can expect from these kind of long short strategies.
Right, Ajay. Thank you so much for joining in and giving us your views on a whole host of sectors, stocks and market positioning as a whole. We will continue to monitor these trends as we go along. He is increasingly getting constructive on the IT space from a 12 to 18 month standpoint, but we'll have to monitor the upgrade to downgrade ratio coming in out there as well. Believes in the case of both long short funds as against just fundamental long only. But remember, this is a business of specialists itself. Not everyone can go ahead and short stocks because that's one of the tougher things to do. But 3 p.m.